Okay, thank you so much, everybody, for joining us for our live Thursday webinar. I'm Leah College, the Director of Real Wealth Realty, and you see we have a bunch of beautiful faces joining us today. This is all of, or a lot of, the Real Wealth team. We are joined today by Grant and Rebecca Anderson. These are our property team managers, a face that you don't get to see as often on our weekly webinars. Of course, most of you know our other investment counselors, Stacy Steganga and Joe Torrey. Hey, guys.
Hi there.
And then definitely a face you don't get to see very often. Celia Christensen is our marketing manager. She's behind the scenes on all of these webinars. So she's always with you in practical sense here, but she's joining us today as well. So hey, Celia.
Hey, happy to be here.
So this is a really fun webinar. We've done this a couple times in the past, and it gets amazing response and feedback. Joe, Stacy, and I on calls with investors all the time who are maybe new to the investing game. They really want to get inside the head of an investor and really understand what are the things you're initially looking at. How do you pick a deal? What do you start with from the very beginning of considering a property? And the answer to that is there's a lot of different approaches. And so, what we're going to do in this webinar today is allow you to see each of our individual approaches and how we initially kind of quickly do due diligence on a deal that we like or that we think is appealing. So, I'll jump into kind of the specifics of how today is going to work, but this is going to be a great opportunity for you to hear 6 different investors' perspective on real inventory from Real Wealth Property Teams. So thanks again for joining us. We love when you are on these webinars live because you can interact with us. So feel free to send in your questions or comments to the Q&A section on the Zoom control panel. We'll have a designated Q&A session at the end and take some questions for you, but we love to interact with you guys who are on live. If you are watching this on replay and you want to be on these live in the future, you can find a list of all of our upcoming webinars. We do this every Thursday, same time, same place, noon Pacific. Next Thursday, we're going to be talking to our San Antonio, Texas team. They're featuring some new construction multifamily inventory with interest rates in the threes, if you can believe that. So that is a webinar you're not going to want to miss. You can scan that QR code there to see all of the upcoming webinars, or from realwealth.com, you can just go to the Connect tab and you'll see our events there as well. Okay, so this is our standard disclaimer. Since we are going to be looking at some deals today and talking about investment opportunities, we want you to know that at Real Wealth, we streamline the investing process. We connect you to some great operators who we have thoroughly vetted, but we, of course, can't guarantee the investments that they offer. And so if you are planning on purchasing maybe one of the properties that's being featured today or working with one of the teams that we recommend, you need to remember that this is an investment subject to investment risks. We want you to do good due diligence to protect yourself in this investment. You can refer to and follow our investor checklist that kind of guides you through some of that critical due diligence as you're considering an opportunity. Always order a home inspection, even if the property has been fully rehabbed, even if the team is willing to provide you with a recent report. Get an appraisal. We don't recommend you overpay for properties. The properties that you are purchasing from our teams should appraise and hopefully have a little bit of equity as well, but they should definitely be appraising for your contract price. So again, we streamline this process. We connect you to some awesome folks, but investing risks still exist. So definitely remember to do your due diligence. So in case you are new to Real Wealth, I quickly want to just high level, emphasize what we do here. We define real wealth as having not just the finances, but the time and the freedom to live life on your own terms. And we see real estate as being one of the best vehicles to create that passive income for ourselves. So we are on a mission to simplify this process for everyone so that you can be living real wealth, so that we can be living real wealth. We think the world is better if we are all living real wealth and really standing in what we're good at and what we love to do. So in order to simplify this process, we curate a list of vetted teams. These are vetted turnkey operators, in some cases, new construction companies. We have a very extensive vetting process. Grant and Rebecca actually spearhead our team vetting process, and they manage the relationships with all the different turnkey providers that we work with. They are fierce in their vetting. It's lengthy, it's thorough. It includes tons of background research, market research, reference checks, site visits, contract reviews. I mean, it's extensive. And once they have done their deep analysis as very savvy investors, they bring the whole team in on what their findings were. And we all together agree that we think this is a good market and this is a good team. And any of us would be willing and want to invest with this particular team. So you get access to these vetted list of teams. Track record. This is for teams that we've been working with. Some of them we've worked with for over a decade. They've sold hundreds of properties to real wealth investors over the years. So we have well-worn track records with these turnkey operators. Some of our relationships are newer, of course, so we're establishing those track records, and that's always disclaimed on our website, which relationship is a little bit newer, but this track record allows you to invest with more confidence. You're not just a one-off investor, you're a part of a much larger collective. And we have seen time and time again how investors have succeeded with these teams and in these markets. So you get to kind of leverage that track record as well. And then the third point is leverage. You are a part of a bigger collective, and so that works to your benefit. Grant and Rebecca, in part of their vetting and selection process, they're very upfront about what our investors are used to and what they expect. They know what a good deal looks like, and so they use that leverage to sometimes negotiate reduced property management fees. Sometimes use that leverage to get them to consider using specific loan programs that benefit you, the investor. So you're a part of that leverage that we've established, representing a very high volume of borrowers. And of course, in the event that there are challenges with a particular team, we use that leverage wisely to try to help the situation. Now, that doesn't mean we can force outcomes to your benefit in all cases, but we do get involved and we do care about how your experience goes and work to resolve that with a team. So that's kind of high level, the benefits of working with Real Wealth. I asked Rebecca to kind of speak to what high level we look for in a market when we're choosing an area. So Rebecca, I'll hand it over to you now.
Awesome. There are so many factors that we look at in addition to all the other things you mentioned. But I just really start with, is this a desirable area? Do people have any interest in it? That doesn't, one way or the other, that just is an interesting question. Some really desirable areas are, however, unaffordable for our investors. So one of the points here is healthy rent to value ratios. So both of us will be running the numbers. We'll use the deal check as well. We'll take all the information that the prospective team gives to us. Then we look at, we do the comps analysis ourselves as well, checking out sales, rents. We'll dive deep into the neighborhoods. So we check out niche.com to look at the grades of the A or B or C. I mean, we start off the bat talking to the prospective team about our members don't want to be in a terrible area. So let's just clear that off right off the bat. We want really nice, steady places that we can rely on. And then we look at some of the top things here: population growth, job growth. I do quite a bit of deep dive into that, and I'm really excited to use AI a little bit more in my research going forward. But we look at the metro, and we look at the specific suburbs that they're in, because most teams are working in suburbs these days, or exurbs even. And so we look at the big picture, and we look at where are people wanting to live, and we take into account news articles, but we look at charts from the Fred graphs, and landlord friendliness, of course. We look at the tax situation, and we look at the evictions, and we just have so many questions that we drill down on. That just touches the top of the iceberg. Was there anything else that you came to mind?
Just going out and visiting the properties too, driving around with the team, getting to talk to them, getting to know who they are, getting to meet the members on their team, their property management, getting to know all of this so we can feel comfortable in making that referral to somebody, because we want to make sure that those people are able to take your referrals and are going to be good to our members to make sure that everything is handled properly.
Yeah, we didn't even go into team experience and construction quality. Those are all other aspects, not just market specific, but there you go.
It's extensive. And I think that the important part we want to drive home is that, all of these different markets, they're different. They have pros and cons. They all meet our criteria to some, varying degree. Some markets obviously are better for cash flow. Some markets are better for appreciation. Some of these metros are much larger. Other metros are much smaller. So there's some variance here. So what we sought to accomplish today was really to kind of help you see how we look at different deals and markets. And we wanted to start by kind of looking at a specific cross-section of markets. So what we did is we reached out to cash flow focused markets. We call these our linear markets. And we specifically wanted them to send us rehab properties. So some of our linear markets, they do some new construction, but we wanted to keep this as simple as possible and have a category of properties that were very similar in nature. So we reached out to 6 property teams that have cash flow, that do rehabs, and we said, send us your best deals. Throw in all of the perks, throw in all of the concessions. We want you to send us the deal that is going to be a standout deal for investors. And so they sent it to all of us. They sent it to Madison, who isn't on here, but she's also in the wings. She works with Grant and Rebecca, and she's the one who tees up a lot of this information from the teams. And she prepared all of the deals that they sent for all of us. And then we all went in and selected a deal that appealed to us. And we have kind of created some slides that speak to what we looked at first, some of our initial due diligence. So what you should know is that all the deals that are being featured today are actually available. As of today, they're available. So you could contract one of these properties if you like it too. But they're also just the tip of the iceberg with these teams. All of our teams have dozens of inventory in their pipeline. So if this specific one, there's something off about it that you don't like, but you like the team, you like the sound of the area, we'll show you how you can get in contact with them to see their full inventory as well. So we have all of the inventory that was sent to us up on the website. We're going to put up a QR code at the end of the presentation so that you can take a look at the inventory and study it in more detail. Okay. So all of us on here are investors. I didn't say that at the top of the hour. All of us own rental property. We've all been investing for a lengthy period of time, varying degrees of experience, varying degrees of different market exposure. So we're all going to first orient you to who we are, what our preferences are, and then we're going to jump into the deal that we selected. So Rebecca is going to start us off. Tell us a little bit about your kind of investing vantage point.
Sure. So Grant and I, we are married, if that wasn't clear, and we also work together here. And we started investing in 2001 in Sacramento, where we're from originally, with just all kinds of random learning. We got some rentals, we did some wholesale, some flips. And I will say Grant was mostly the leader at that time, but I was along for the ride for sure. But then we 1031 exchanged our portfolio into Indianapolis, Indiana, and then we ended up moving there together. And then I definitely got way more involved at that time. I also became a realtor and helped ourselves and some other investors buy and sell flip properties along with rentals. So I was able to kind of learn about the industry from that perspective as well. And just to our type that we look for, we definitely look at the market and the neighborhood. We like a solid and dependable tenant base near a metro area with a population and economic growth, just kind of like what we look for in general. And I do like positive cash flow on my deals. I was lucky enough to be able to get to pick the Indianapolis team property. And there we go. Just making sure I'm saying that correctly, the way we're supposed to say it. So when I immediately saw this one in Newcastle, Indiana, I did know where it was, but I was approaching it from someone who was looking at it and may have not known. But what first thing that I did do is go back and watch the latest webinar from the Indianapolis team, just because I wanted to get myself familiar with who they are and what they offer. And that was a great reminder that this team has just such great experience and trustworthiness, in my opinion, that made me actually feel really extra good about this. They all do, but that just really got to me for this particular one. And so Newcastle is a very small town, which I do mention on the next one. But so I guess maybe it's a little backwards because I immediately started looking at the area and the town first, and then I kind of dug into the property a little bit more. But the property itself, being a 3-2, around 1,200 square feet, is a perfect size. I was glad. I personally do prefer 2 bathrooms or more. I know a lot of markets have 1 bathroom, and that's fine, but I was just glad to see that on this one. I noticed it had a huge lot and yard, and I was like, oh, people are going to love that. And I took a little Google Maps view around the neighborhood just to see what's going on. Now, of course, this one is still in renovation, so they don't even have like the most updated pictures. There's the ones on the right, it says example, and the one over here I think might be a prototype as well. So when you first see it, you're like, oh no. But that's because then they do the transformation. And I looked across the street and I'm like, oh, they're so nice. Their lawn's all mowed. Everything's all kept up. I went down the street a little further. Everyone's got all their nice little stuff in place. That, to me, those are the things I look for. So I guess that's what we're going through here. I'm looking for, do people take care of their lawns? Do they upkeep on the house? Is there anything, there's no trash in the yard, stuff like that. It's all clean. So I was really happy to see it was a neighborhood that people seemed to take care of their homes. And it's right here in the downtown. So I was looking at the map and I was like, that seems like a really good access to wherever you want to go, whether you're, just kind of working nearby or, wherever you want to go. It seemed like it was a really good location. And I threw this one in here, but it'll also probably go on to the later slide. I specifically asked the team, how is the rental demand in this particular town? Because it is a small town on the quite a bit of outskirts of Indianapolis. And she was saying they really have a high demand there. They get, I didn't write down the exact words, but they get applications, and usually within a couple weeks at most, they would expect it to be rented out. So I loved to hear that. And then I have more on the next that we can take a look at. So the $179,900 price, I also loved. I did compare with the other properties in this neighborhood, and it's right on the mark for the nice ones. Other nice ones were just as good, if not more expensive. But I knew instinctively, which you guys will know too, once you start looking into a market, you'll start to get to know it. And so I knew that this type of home all throughout like central Indiana, it's going to be like probably in the 200s in other areas. So this town, just being a little further out, it's going to be a little bit lower. But the rents are going to be pretty similar. So I really liked that rent to price ratio, and knowing that these are really good. That's really good rent as well. And so we got $179,900 for price, and you only have to put in about $50,000. And then of course we want to have some reserves. So I just we're probably going to have similar numbers amongst all of us today, but I just like that. That's a great way to get in there, get a property. It's not, too much out of pocket. And so I do like that. There wasn't as much else I was going to cover. I know I guess I can do the normal deal check rundown that we normally talk about. Deal check is our software that we love to use here at RealWealth. So we encourage everyone else to go ahead and use it. We've got the QR code, and you can plug in all your numbers. So we plug in for these linear markets, appreciation around 3%, income increase 2%, expense increase 2%, and selling cost 6%. Those are just some standard numbers, but you're welcome to put in your own different numbers to see if that's different numbers that you would like. We also do not include maintenance and vacancies in these, because those would also be kind of your own costs that you'll want to determine. Some people might want higher, some people might want lower. So we encourage you to add that yourself. And then we do show the returns over the years, year 1, 5, and 10. And we're encouraging everyone to always look farther on, not just year one, because we're not in it just for 1 year. We're in it for the long term. We want to see these over time. And in 10 years with this property, 127,000 equity, that's really nice. It's in it to me, it's like put it in 50 now. And since the team has done all this great work on the rehab, over the time I might have some maintenance and some turns, but in 10 years, 127,000, I love it. So we also have some cash on cash return in year one at 11. So I know we're going to be comparing some of these numbers. And down here at the bottom too, these internal rate of return and return on investment are negative in year one. That's because you don't want to sell your property in the first year because it costs too much to sell it. So that's just also our basic rundown. I hope I did decently enough on the deal check. And I'm going to jump into my next slide. So this particular piece, I actually copied and pasted from the materials that the team gave me. I was really impressed with the materials the team gave. It was a pretty significant document. They actually also use deal check. So it was nice formatting for us to be able to sift through those numbers. But I also compared this when I ran it on Zillow. It was pretty much the exact same. So I just liked the way they presented it better for the slide. But I was able to confirm that Zillow had some of the same sales comps. They were all similarly priced, if not higher, for the same square footage. Having been a realtor before, I just immediately know that I always try to compare like for like, which I encourage everyone to do. So I'll narrow the square footage down to where it's within only a few hundred feet of the same one. I'll narrow the price so you're not looking at the junks. So you just at least start at 150, to get them closer there. And you want to, keep it within a close distance location-wise. We kind of like using niche.com. It's overall just gives us some good ways to look at things. And I threw in the zip code here. They gave it a B-, which is kind of what I expected. This is not an A class. I already knew that, but it's nor is it a D. So that's right in the sweet spot, right in the middle. And that's where we're going to get our good cash flows too. I loved the cost of living is really high here. We have housing, good for families, jobs, all right in the nice range, even public schools B. So small town up here. Oh, this is one of the things that the team told me about, but I also verified when I was looking on the maps, like Google Maps. There's these various parks around, County Park and several county parks. I really saw them around. I'm like, that's really nice for people to be able to go and recreate. The Indiana Basketball Hall of Fame, that's kind of cute. And this huge Newcastle Fieldhouse, largest high school gym in the world. So with it being a small town, they only have a few little claims to fame that I thought those were nice. And I think that the residents would like that. One thing that I do know about Indiana that the team also talks a lot about is that people like living in all the areas, even if they're a little bit more rural, even if they're on the outskirts, even if they're a small town. The whole area out there, whole of Indiana is just populated with people that like living in whether it's a small town or the rural or closer to the city. And so that is confirmed by my experience there and what the team says. And I guess kind of one of my final points on here is there was only one other active rental when I was looking around in the range of this size of the 3.2. And it was not as good as this one. So that kind of confirms for me that there would be demand here, because when you see tons and tons of rentals, then that means could be some oversupply versus demand. So I didn't see that here. And then I'm almost done, but double checking my notes, I realized I didn't really put anything on my slides about the team is offering some incentives. So I was glad to see that, and I actually confirmed with them because I had heard them talk about it on the webinar. And then it wasn't, I couldn't necessarily confirm it from the materials. So I just wrote back, can you please, confirm which incentives you're offering? And so they let me know about that. So I'd encourage you all to talk to the teams about that. And they even said there's a possibility of a price reduction if someone asks. And so I was like, okay, I guess I'll just throw that in there. And they said they would be able to negotiate about 5,000 off. So you heard that here from me. Just to clarify, some teams are open to negotiation in this market environment, and some don't. And the ones that don't get mad at them. That just means the price is what the price is because of the cost that it is. And then some are willing or need to move them. Everyone has their motivations, stuff like that. So I don't think it hurts to ask, but some do and some don't. So that's my little talk.
Great. Rebecca, there was a couple questions. A couple people wrote in. They noticed on the pro forma that the property management line said 0. Did you touch on that?
Oh, cute. That was one of the incentives for the first year. They are offering free property management. That is why.
Yeah, so not a typo. The parentheses there showed their amount, which I believe is 8% or 9%. I'm trying to go from memory here, but yeah, free for the first year of purchasing it. So that's great. Okay, so next up in the chute is Joe. Joe, tell us a little bit about your investor preferences.
Thanks, Leah. Okay, so as the slide says there, I've been a real wealth investment counselor since 2016. In fact, tomorrow, August 1st, will be my 9-year anniversary with the company. I've been investing in real estate since 2004, a little over 20 years now. My personal philosophy is to have a mix of cash flow properties and appreciation properties. So half of my portfolio is in Alabama for cash flow, and the other half is in Florida for appreciation. In my mind, it's like having a balanced portfolio of stocks and bonds. So I like to have a mix. I could have 2 vacancies and still my portfolio will be cash flow positive because of the Alabama properties. Okay, so unsurprisingly, the property I chose was in Birmingham, Alabama. It's purchase price $171. It's actually in a suburb of Birmingham called Adamsville. It was built in 1950. So it's old on the outside, but it's new on the inside. They renovated, a really thorough renovation. They took it down to the studs and rebuilt the house from the inside. So a brand new electrical, plumbing, new HVAC, also a new metal roof. Metal roofs last 40 to 70 years, so you might not have to change the roof until 2095. So that's a major CapEx item you can take off the table there. And this one actually got rented in 11 days, indicating a high demand. So I'll just run through the numbers very quickly because you got the idea from Rebecca how to read these things. First of all, that's only a 5.5% interest rate with no points. The team there has negotiated something with a lender. And as a result of that, you only need to put 20% down to make the numbers really healthy. So we have 80% loan to value. So with down payment and closing costs, you're all in for about $39,000. And the rent, it says estimated rent on a previous slide, but it's real because they just rented it in 11 days. So that's the rent. You can see the expenses. One thing I like to point out is the taxes. Alabama has the second lowest property tax rates in the country. So the property taxes are really low, and that really helps your cash flow. You get to keep more of your rents. And so the monthly costs are under $1,000, and you get $342 a month in positive cash flow and $4,000 a year. So you take the $4,000 annual cash flow and divide it by the $39,000 original investment. You've got double-digit cash-on-cash returns. So, oh yeah, cash-on-cash return 10% in the first year, growing to 13, then 17. Over time, rents go up, so your cash flow only improves from there. So here's where it is. It's a suburb of Birmingham, as I said. It's less than 12 miles to downtown Birmingham and less than 5 miles to Forestdale, which is another employment center. I did some research and found out that 89% of the people in Adamsville own, and only 11% rent. That's good because owners have pride of ownership and they take care of their properties. They mow the lawns. They don't let junk accumulate on the lawn or anything like that. So you have your investment is protected because the people around you want to keep their houses nice. Renters don't care as much about the house because they don't own it. And neighborhoods that are like 90% renters tend to deteriorate faster. Also, you notice on the map, it's very close to State Highway 78 and also Interstate 22. And I think that's really important. I like having properties near freeways because what that does is open up your tenant pool. If your tenant has to drive 20 minutes just to get to the freeway, then when you have a vacancy, your tenant pool is really limited to the people who work in the immediate area. Whereas if you have quick access to a freeway or a state highway, then that opens everything up. Anybody who lives 20 miles north or 20 miles south is a potential tenant. So you can fill your vacancies a lot faster. And then the other thing I like, of course, is the state has low property taxes, as I mentioned, and it has multiple investable markets. You have Birmingham, you have Huntsville in the north, you have Tuscaloosa to the west, and Montgomery, Alabama to the south. Every one of these markets has a very different economy. So one thing that investors have to decide is the trade-off between diversification and too much concentration. And what I like about Alabama is you can be diversified in 4 different markets, but all within the same state. And they're all within driving distance of each other, within a driving distance of Birmingham. So I've seen investors over the years make mistakes like they buy 5 houses in 5 different states. So they have to file tax returns in 5 different states every year. They're dealing with 5 different property management companies. They have to open up LLCs. So it gets unwieldy. So having multiple markets within one state is very convenient. Some other considerations, you can see some of the rehab work that was there. It's a 4-bedroom, 2-bath, and that appeals to families. And families with kids are more likely to be long-term tenants. Once the kids are enrolled in school, they pretty much stay put. And as you can see from some of the photos there, they did a great job on the rehab, the tile work, the fixtures, LVT flooring, the countertops, everything. Now, one thing that gave me pause initially was the garage doors. You can see there that it has 2 garage doors. I personally always look for 1 big garage door rather than 2 little garage doors. This is Alabama, and everybody drives a monster pickup truck. So it's easier to get a monster pickup truck inside the garage when you have 1 big garage door instead of 2 little ones. So that's my preference. But in this case, what's noteworthy that these garages are oversized. They have 12-foot high garage doors versus the standard 7. And that's really great because you'll rent this to somebody who has a Winnebago or a camper van or a boat or something like that. And once they're in the property, they'll never leave because they're never going to be able to find another place with a 12-foot garage door. So this was actually a selling point. So that's my rant about garage doors and why I'd be willing to make an exception in this case. And finally, you should go into this investment with your eyes open. This is a cash flow investment. It's not going to appreciate wildly like Florida or Texas. You'll get some equity growth from the tenants paying down your principal, but mainly what you're doing here is you're buying an ATM machine. And the ATM machine is going to generate cash, $4,000 in the first year and growing from there. And if that's what you're in the market for, this would make a great addition to your portfolio. So that's my take on that property and why I liked it. I think Celia's next, and she's going to talk about Chattanooga.
Okay. Yeah, so I'm not new to RealWealth. I've been here about 8 years total, but in this role 6 years. So if you've heard me talk before, I've seen a lot of webinars in my day, which means I've seen a lot of pro formas passing through my screen. So I've had the chance to really kind of get this broad education over the years of what's out there, what's happening in the market. So my first out-of-state rental property I bought just a couple of years ago. And that was kind of a big jump for my husband and I because previously we'd just done in-state and I was our landlord and I preferred that control and just in the know of everything happening. So switching gears to out-of-state was kind of a big leap for us. And in case I was on the Real Well show with Kathy a couple weeks ago, and I talk a little bit about the challenges we've had with that property. But you can watch the podcast if you want the whole story, but we've kept it, and I talk about even the challenges we had, how keeping a long-term perspective really has affected our decision making today. So I try to keep that long-term perspective when I'm looking at deals, what's happening today, but then also what might be happening in a couple of years. So that property's in Florida, and our next step is we want to look elsewhere to diversify, and kind of going for the more appreciation play at this point, because I think that is going to be our best bet. We have 4 kids, 2 dogs, a tortoise, and I work full time. My husband works full time, and my life is crazy busy. Who's not busy, right? But we just, finances are tight. So for us, the best thing to do is always going to be an appreciation play. So the next market I have looked at is Chattanooga. The team we work with in Chattanooga is newer to us, Real Wealth, but they have, extensive experience in the real estate realm. So this property that they are currently offering is really unique. It falls technically under the rental resale category, which means that they have not, some teams in rental resales, they've rehabbed the property a couple of years before. In this case, a realtor they work with reached out to them and asked and said, hey, I've got a seller who really needs to sell this property fast to make their next property come through, right? So they offered this to this team that we work with. And so they were able to get some equity on it because it was a need to be done, very motivated seller deal. So this property, built in 1973, was rehabbed fully 2 years ago, but not by this team. But they have a whole scope of work on what was done, including the new roof, just off the top of my head, new water heater, fully refinished hardwood floors, which I know is not cheap. It needs to be done at my current house. And so they have a scope of work on what was done. I asked them about what might need to be done in the future. The property is currently tenanted. This is one thing that I was excited to hear because it doesn't guarantee that rent because that tenant is moving out and they are going to make some changes to the property. And then so they will assume the cost of that, but none of them are big CapEx items, but they're really comfortable and confident on that estimated gross rent of $1,650, which is huge, right? At the end of the day, most pro formas are estimates only. So even though this tenant is moving out, they're confident that they will get that much or maybe a little more going forward. So it's a good neighborhood, desirable, 15 minutes outside of downtown. The things I look for again on this, I noticed there was a question earlier about property management being zero. This is one of the incentives. This team is also running free property management for the first year. So that is a really nice incentive to capitalize on now, because as we know, once interest rates come down, incentives and things they're going to go away, right? Because they're motivated to keep stuff moving right now. The thing I also really liked for more beginner investor, or just someone who maybe you're not a beginner investor, but you don't have hundreds of thousands of dollars because you're tied up in other stuff, is the total cash invested just over 60,000. It doesn't feel crazy scary to me. And then I will show going forward on one of my next slides, just kind of the change in, I got in deal check that Rebecca talked about here and played around with some of the numbers. to see how things might change in the future. But I felt really good about what things are looking at right now. Year one, cap rate, cash on cash return, 10%. Like, I am not going to be mad at that at all. So coming out with an estimated cash flow of $500 a month sounded really good to me. Sorry, I'm going to jump back here. Comps on the same street have sold. This is one of the smaller houses in the neighborhood. So the comps have sold for 250 to 300. And because they were able to get this property on a good deal and haven't had to put much into it, they're able to offer it at just 209, which means, instant equity for the investor. I used to wonder, if there is that equity, why don't you just keep it? Why doesn't the team just sell it for the higher rate? And I've talked to multiple teams about this, and they're like, for us, time is money. We have to keep going because we can free up this capital to then do our next deal. And this is wholesale. We bought it wholesale, and we are selling it wholesale to an investor, not to an owner occupant. Some of these I've already touched on. I like that this picture I pulled from Zillow. I went and looked at all the specs on Zillow. This is the current tenant in the home. It looks like it's still been very well maintained since it was fully renovated 2 years ago. And again, I really like that low entry cost, just over $60,000 to get into this one. Real Wealth is perfect for me in that as I mentioned earlier, I have a lot going on, and I put a lot of trust and faith in proven processes. So for me, it is the markets that Rebecca talked on earlier, why we choose the markets we have chosen, what markets we're working in. And secondly, the teams that we're working with. No team's perfect, no property is perfect, but that has taken so much of the legwork out of this for me. And I know Stacy, who I believe is next, she can speak to that as well, because she went it alone for herself and it took a long time. It takes a lot of energy. So it was very nice for me to reach out to the team. Okay, what other CapEx expenses do you think are coming up? And they can provide that scope of work for me. Obviously, this is not a guarantee. I know that going in, but there is that established track record we have with them that we trust what they say, but we are going to verify on all these other avenues that we have at our disposal. I also looked at potentially refinancing. This was at 6.6 interest rate. So I was like, well, what would happen if I can refinance? I got into Deal Check and played around with the numbers and changed things up, and how much better things will be if I refinanced even at 5.5. After a year, they have a property management fee every month of $100. So that will kick in a year. I factored that in. I'm coming in with estimated monthly income of $500. So that goes down to 400. Maybe in the next year or two, I can refinance. Just some things to figure out. I'm trusting the numbers from today, but I'm also going to play around with them a little and see. I plan on holding it, but I also am not opposed to refinancing when rates get better. As Rebecca talked about, she looked into niche.com, and we did have a question about niche.com. Yes, it's a great resource for colleges, college towns, all of those things. It also just is a great resource for getting to know communities better, cities. Obviously, this is coming in, it factors in public schools, housing, and then it breaks it all down. It's such a great resource for areas, not just schools. So take a look at it, and it's free. You don't even have to sign in to get all this data. So I liked what I saw on Chattanooga. I think it's a good investment appreciation play. So that's where I have looked. My advice is always use the resources you have. Real Wealth, I pick Joe and Leah's brains, and now Stacy, on anything I've considered, and then talk to the teams. That is my first step in evaluating a deal, and then I will go further after that. Moving on, I think we have, Stacy.
Yes. Hello, everyone. So as you know, I'm an investment counselor here at RealWealth. I've been here since January. And as Celia said, when I first got started, I was stuck in analysis paralysis. So I spent over 2 years learning about real estate investing. And that was because I was listening to too many different sources. I have then since started, I should say. So I've been a real estate investor for 5 years now, and I was focused on out-of-state investing in cash flow markets so that I could leave healthcare. So the deal I chose is this one in Dayton, and I will first preface that I was born and raised in Michigan, so you will not often hear me say nice things about Ohio, but I was actually stationed in Dayton. I went there for flight school for the Air Force, so I actually have a really fond place in my heart for this area. But then additionally, you immediately look at the purchase price and then you look at the rent. And we are $14 off from hitting the 1% rule. And everybody says that doesn't exist anymore in real estate. And so I'm just immediately attracted to this deal. I additionally love that it's a 4-2. That tells me that it's going to attract a great family. They're going to be a long-term tenant. It's in a B-class neighborhood right next to these amazing attractions. It's 5 minutes from Dayton's Children's Hospital. This golf club also has a really nice pool. And then that's the actual photo of the library, all within this B-class neighborhood. So again, this is perfect for a family, and that tells me they're going to be a great long-term tenant. And then again, with the market being so strong and backed by Wright-Patterson Air Force Base, but then having all those other industries supporting the economy, I'm a huge fan of this market and this neighborhood. So I'm going to continue with my due diligence. Now, anytime you really get into the strategy of real estate investing with a cash flow property, there's 2 ways that you as the investor have control over improving your returns, and that's by increasing your income and decreasing your expenses. So starting with the end in mind, I'm going to immediately dig into verifying my rent assumption on a pro forma. So this bottom graph I actually created with the 2024 and 25 data. So you can see the purple is our rent assumption on that pro forma, which is extremely conservative compared to the 2 different sources that I used. And then additionally, the green is the market average for all of Dayton. And so that tells me we have a lot of rent growth that can be appreciated. And so my numbers can get even better than what they already are. But then I want to double check that that's not an anomaly. So then I look historically, and you can see the blue on the graph above. That was the 2022 rent projections. And then the orange was 23. So we had really impressive and consistent rent growth, and it's sustained. So I love all of that. This specific property has a tenant in place since 2022. So again, that's telling me that my rent can go up significantly, but they're in place until 2027. So I don't have to worry about vacancy. There are 2 adults and they have no kids and no pets. So that means my turnover is going to be really low. They've never been late. So that means they're an ideal tenant. And then just like Joe, they have an attached garage, a large basement, a large lot that's fenced, and hardwood floors throughout this property. So that means they're going to move in and they're not going to go anywhere, because once people use all that storage, they don't want to pack again. Additionally, this property had an appraisal recently, and there is $8,000 of equity, which was a really conservative assumption. So I already know I'm walking into equity on this deal as well. Then I'm going to look at my expenses and what could take those awesome returns away from me. So this property was built in 1939, but it had a complete rehab in 2018. They addressed all those major systems, so I'm immediately checking those off my list and then understanding any remaining items and when they might be due for repair. The seller has already agreed to pay for all the repairs on the inspection. that were found. But then additionally, because it's a rental resale, I'm going to have that $1,500 held in escrow for the first year of my ownership so that if anything breaks, I don't even have to worry about it. So that's another added layer of security and benefit to my numbers to be considered into my underwriting. And then the biggest thing that I love, when you're buying on the free market, one thing that people don't fully appreciate is that you don't know the performance history. The person that's selling can withhold expenses that can ruin your numbers. And so having the known performance history on this rental resale with the property management, I'm like, sold, no surprises. That's huge. It's additionally coming with a reduced property management fee for the first 2 years of ownership. And then it's a brick building, so that's durable and low maintenance, not a lot for me to worry about. So then we look at these numbers. That's a super low purchase price for a 4-bedroom home. I love that. Low entry to get started in real estate investing. But then, like I said, we already checked that rent and we know that's way below, so that can improve. But I say on every webinar that maintenance and vacancy is left off of these on purpose so that you can add it according to your own risk tolerance. And this is a perfect example of that situation. So it was built in 1939, but rehabbed in 2018. So that means I don't have a lot to worry about. But then additionally with that escrow, I could potentially have zero maintenance in that first year because it's going to be covered. And then the tenant's already in place, so I'm going to have zero vacancy. But even with an assumption of 10% to cover both of those items, I'm already cash flow positive as it is. And then I take that 10% off and I'm still over $170 of cash flow. So that's a really strong investment property. Then on this right-hand side, you can see the income increase is projected at 2%. The numbers I found supported way over 5%, and that was on that previous graph. So again, conservative consumptions are still going to get me even better returns. I have a double-digit cash on cash right there. So long story short, this is a low risk, high entry or high reward. High upside is what I was trying to think of. So this is the perfect property to get started in real estate investing or to add to your portfolio for a really strong cash flow. And again, to realize that upside in your own returns. I think Grant.
Am I the only one who's hearing each one of these deals presented and going, oh, that one's the best. Oh, that one's the best. They're all pretty good. Stacy, you made that sound awesome.
You haven't heard mine yet, so
Okay, well, you can win me over.
Yeah, so I'm Grant Anderson. I started investing actually before we got married in 2001 in Sacramento. I bought a house while I was in college. I did house hacking, like a lot of people try to do, but I just bought one house and rented out the rooms. I've done a lot with real estate. I've done wholesaling. I've done flips. I've bought through my IRA. I've done 1031 exchanges. Never actually through RealWealth. I was doing it pretty much on my own before I started with RealWealth, and I pretty much try to do the BRRRR strategy with most of ours so we can build in that equity. And where we can increase value. That's one of the reasons why we moved out to Indianapolis, is because I wanted my own boots on the ground to be able to do all of that, which is very difficult. Ask me in another webinar about doing it from a distance. There's a lot of challenges with that. So
If you're not using the
if you're not using the teams that are there. So I don't have any type of slide control. We can go to the next slide. The property I chose was in Cleveland, from the Cleveland team, and it is in Maple Heights, Ohio, which is kind of right outside of Cleveland, not very far away. This property is the purchase price is $145,000. It's a 3-bedroom, 1 bath, about 1,056 square foot. I like that it's 3-bedroom, 1 bath because that is what's typical in that neighborhood, in that area. So that's a great place to be. It is a rental resale. It was something that was rehabbed by the team about a year ago. It was fully rehabbed. They have new vinyl plank floors on the first floor and the bathrooms, carpet upstairs in the bedrooms, new shoe molding all around, brand new kitchen cabinets, new hard surface countertops, new dishwasher, new shelves in the pantry. They reglazed the tub. They have a brand new water heater and replaced all the switches and all the outlets, and redid all the lights, fixtures, and the plumbing fixtures. This is a Section 8 tenant that is in here. Let's go to the property analysis. So the purchase price, like I said, is $145,000. The rents on this are $1,525. That is what the team put, and I'll go into a little bit more of what I found out with talking to the team about that. But that does beat that 1% rule. So if you're looking for 1%, this actually beats it. So that's good.
Take that, Stacy. He beat your almost 1%.
I know, my goodness.
Sorry. The cash on cash return, 10% at year one. And then the cap rate is at 9% at year one. Again, you don't want to sell in the first year because of real estate agents' costs. So that's why these rate numbers down here at the bottom are not good. The monthly cash flow on this is $369 a month without, of course, taking in any maintenance and repairs that you might want to put in yourself. Some of the things, this one was, I noticed that it was a Section 8 and it just kind of caught my eye. I personally don't have any Section 8 properties myself currently, but it really caught my eye because it is something that people are talking about. It is something that there are mixed reviews on as far as what you can do with it. So the first thing I did was look, because you'll get a lot of emails from teams as you start talking to them. They're going to send you emails. So the first thing I do is look to see if this is going to meet my quote criteria to find out if this is going to be a good property. So I just kind of threw it into ChatGPT to get me a overall analysis. And so one of the questions I asked was, what are some of the pros and cons of Section 8? Well, some of the benefit is it's a guaranteed rent for the most part. I mean, unless the government goes belly up, you're going to get rent payments. In high demand areas, you can get higher rents. And this is the case in the Maple Grove area. You can get longer tenancies. The team says, on average, at least 5 years and higher than market rents. So you can get higher than market rents as well. And you're also doing some social good, allowing somebody to live in your home that may not be able to afford it, but can still qualify with government assistance. Some of the drawbacks is obviously there is some bureaucracy and there can be some delays. You have to maintain your property at a certain level. The rents can be capped, and there is an approval process, which is kind of happening right now with this property. You have limited control over the tenant selection sometimes, and sometimes they can have a little bit more wear and tear. One of the other reasons why I liked this Maple Grove area is because it is 68% owner occupied. And so my thought is that if I ever decide to sell it, or when somebody decides to sell it, they could sell it to a homeowner. And homeowners typically pay more than investors, has always been my experience. I did do some deeper dives into it. I looked on Zillow, and Zillow was very hard to analyze this. So I looked for properties that were for rent on Zillow in that same area. And that was a little bit harder because none of the houses looked as nice as this one currently looks. And it's already rented, so it's a little bit difficult to find other ones. I also looked at for sale and sold properties, and there was one property that sold for $162,000. This one's offered at $145,000. The $162,000 has similar square footage, similar bathroom, and it's updated in the same way. So I know that there's some equity in there. I also saw one that sold for $155,000 that didn't have as much updates. It didn't have as nice of cabinets, and it didn't have the hard surface countertops. It more had laminate. So I know that 155 is a low number for what this one could appraise for, or what it could eventually be worth. And then the last thing I did was I created a list of questions for the team to ask them questions about what I was seeing based on this. So some of the questions that I had for the team was about that tenant. How long ago? When did that tenant come in? That tenant has been there about a year. Currently, they're paying $13.81, and that doesn't sound very good, but they have requested from the Section 8 a $17.50 rent. Now, in talking to the team, they don't think they can get the $17.50, but apparently they ask for the moon. If they get it, that's great. If they don't, they conservatively put in 15, I think 1545, because they recently got one. So it could get 1545, but the team said basically 1450 is probably the lowest that the increase should go to. So there is an increase that there is pending right now with Section 8. That is one of the downsides to it. And the team did agree that my analysis of having some equity into it, this is a C or B neighborhood. And the last thing is one thing that I didn't like about it, if you look at the photos, is that it had some tile that is old from the original rehab. I didn't really like that. I thought it would have looked nicer if it didn't have that. Talking to the team, they made sense on why they kept it. They said that will help tenant proof it a little bit, but it's something that I might want to do if the owner might want to do when they decide to sell. If they ever decided to sell, they could go in and redo that. It shouldn't be too much, and then possibly get the highest amount that they could on a resale whenever they decided to sell it on the open market. So that's it. That's my whole thing.
Great. So a little bit of my investor's perspective. I bought my first rental property in 2010 as a house that we kept. It was a house we lived in for a short while, just knew basic math. Hey, this one is cheaper to own than it is to rent, the one next door. How about we buy it and then we'll turn it into rental when we leave? And so that was our first kind of segue to real estate. And we went back to that market a couple times and bought more as our confidence grew in that thought that we could own for less than it cost to rent it out. And really, it wasn't until 2017 that we started very intentionally scaling elsewhere in markets that were unfamiliar to us and scaling through RealWealth. I was a member for years before I came to work at this company. I focused initially on high cash flow markets because I was working a job that I hated at the time, and this was how I thought I could quit my job sooner. I could also probably do another webinar on what I learned in that aggressive pursuit of high cash flow. Sometimes those high cash flow properties are high touch and high drama and high expenses. So I have some lessons learned there from that. More recently, I would say over the last 5 years or so, I've been kind of hyper-focused on growth markets and kind of counterbalancing some of that cash flow stuff with more appreciation stuff. But I still try to look at my portfolio as a whole, right? So I like that diversification. I invest in Texas and Florida for more of that appreciation and growth potential, but then I still invest in Alabama and Ohio for more of that cash flow potential. So, like I mentioned, I've been really focused on refining that portfolio, focusing on quality over quantity. I want quality finishes. I want the house to be aesthetic. I want finishes to be durable. I heard someone say once, weird houses get you weird tenants, and I think that's probably true. So I try to think, Grant, I'd probably be with you on the weird tile. Like I like it to have that aesthetic appeal because I know it attracts typically a person who cares a little bit more about that kind of stuff. I obviously am looking for strong rental demand, just like everyone is here, and tenant retention. That's what was killing me on my high cash flow properties was frequent tenant turnover. If you have to make ready a cheap house every year and you've had tenants that have been rough on it, like it's impossible to gain traction. And so retaining a good quality tenant for a long-term time is most important to me. And then again, these are just basic investor fundamentals. I want long-term fixed debt. I want great principal pay down. I'm looking at the 10, 15-year time horizon, not looking for necessarily a home run in the first year or so of owning a property. So that's a little about my kind of preferences. So since obviously the theme was cash flow markets, I was looking for, this counterbalance property that gives me all of those aesthetics and durability, but offers a little bit more cash flow. So I picked a property from our Columbus, Georgia team. This was a cute little neighborhood. The purchase price for this was $175. The pro forma estimated the monthly rent at $1,500. I'll jump into some of the due diligence there that revealed the rents were a little different. 3-bed, 2.5 bath, 1,400 square foot. It's a cute little place. The team initially described this area as just being a prime location. It's near Fort Benning, which is a very large Army base. Columbus is about an hour and a half or so southwest of Atlanta. So it's a small town. This is a much smaller population, but that military base is a huge driver of the economy there. This house was fully renovated top to bottom. I did request the scope of work from the team, so I reviewed that, and it was extensive. They got a new electric panel, which is pretty major. They did a lot of plumbing work, redid all the fixtures in the bathrooms, all new flooring, all new appliances, all new light fixtures. I mean, it got a full cosmetic overhaul. This team is offering free property management for 2 years, so I like that. Gives me a little bit of extra cash flow at the front end. And this is the information I got when I was talking with the team. They actually got 2 applications on this property this past week. They had to reduce the rent. It was sitting a little while. I found that in my due diligence as well. So they reduced it to $1,450, and then they immediately started getting applications. So he said that they should be placing a tenant in this one by next week. And you can see the photos there. It's cute. It's a cute little blue kitchen, with cute aesthetics. So it's a good looking property. Here's the numbers. So what you should know is that we had already teed up all this pro forma before we knew that the rent had been reduced to $1,450. So the actuals on this are going to be a little bit less than you see here, $50 less than you see, but really strong returns on this one. Again, I kind of agree with Celia. This is that low price point. This feels less risky to me to be getting all in on this deal for under $50,000. That feels really doable. Monthly cash flow will be just over $400 a month when we factor in that $50 less in rent. Okay, if you go to the next slide, I'll dig a little deeper into some of what I looked at first. So the thing that stands out to me the most about this market is, of course, the base. I own quite a few properties outside military bases just because I'm married to a military man and I've lived in a lot of military bases. I have a very high comfort level with a military tenant because I am one in many places where we've lived. So this was really appealing to me about this area. It is extremely close to Fort Benning. I put it in Google Maps to get to the main gate was like 8 minutes. And if you talk to a lot of people who live in military towns, that is like their number one criteria. I will never understand it personally. I like to have a little bit of distance between my personal life and my profession, but it is so close to the base. So this would be ideal for a military tenant. Of course, they're the largest employer in the area. There's over 40,000 active duty and civilian employees on the base, but it services over 120,000 individuals. So it's looking at families and supporting, services, all of it, over 120,000. I love driving Google Street View. This could be a hobby of mine. I drove the neighborhood quite extensively. Very nice area, really well kept lawns. There was very little disparity, which is something I always look for. I don't want to buy the nicest house in the neighborhood. I want to blend in with all the homes in the area and in a good way. All the yards were well kept. The homes all looked tidy. It was really nice. And there was a park just down at the end of the street. So all these things are going to be really attractive to a renter. I also love niche.com. So I use that, of course, and learned that over 73% of the households in this area rent, in this zip code rent. So there's going to be easy rental demand for this particular property. I won't have any problem keeping it rented. And then I did some look because I know that this tenant is, ideally would be a military renter. I did some online searching to find out what the basic housing allowance is for a military member. And this is public information. You can put in a zip code and you can look at all of the ranks and see what their housing allowance pay is. That's a portion of their pay that is adjusted based on the zip code where they're stationed. And so for the absolute lowest enlisted rank, the housing allowance is $1,590, and then it goes up from there. The absolute lowest officer rank housing allowance is $1,690. So I felt really comfortable knowing that this home is very much within that price point. So again, I can see my tenant. They love that it's close to the base, and they love that they're saving money every month on their housing allowance because that's tax-free savings, tax-free income for them. Okay, so I did some due diligence on the neighborhood. This is what I found. So I used rentcast.io. Okay, well, first let me back up. When I went on Zillow, that's when I saw that this property had been listed for 28 days. I went and looked at the history of rent prices and saw that they had reduced the price from $1,500 to $1,450 just a few days before I looked at it. And like I said, when I spoke with the team about this deal, they'd already gotten 2 applications on that. So that's great and really promising. Rentcast.io gave me the rental projection of 1230. And I noticed what I love about Rentcast is it gives you a whole bunch of rental comps in the area, and it gives you all the addresses. You can see them there at the bottom of that image. And so I click on all those addresses, I put them into Google, and I go look at their Zillow and look at what those homes look like to really be sure that they're actual comps, right? And I did see that there were some that were very low and they were not true comps when you looked at them. So they were pulling down, I think, the rent projection there. So it was just a notice on my part that my due diligence was incorrect on the actuals that the team was seeing there. What I noticed when I was clicking on all these addresses is that the property team manages other homes in the same area. So some of these comps are actually managed by the team. So I loved that because that tells me this team has experience in this neighborhood. They know it. They've already rented properties to people in this neighborhood. So I put the little arrow next to those. Those were the 2 that were already under management of the property team and rented. So they anecdotally just shared with me that this pocket is like extremely desirable. They said they love this area. They said that the tenants who live in this little part are very loyal to this specific area. And so he said that it has just been kind of a gem for them. So that was all good news to me. Again, tenant retention is one of my big sticking points. Okay, you can go to the next slide. Oh, did I have one more? I thought I had one more slide. Go back one more. Oh, okay, here.
Oh, sorry.
The bottom portion here is what I wanted to share. I touched on some of it. The scope of work, again, was extensive. I liked reviewing that. This was my one point that I found. And so I'm just keeping it here to keep it real. When I was looking at comps in this area, it did look to me like the purchase price on this home was a little bit high. And as I was discovering that, I started having additional questions like, why is it priced higher? And it's part of the reason why I called the team and spoke with them about it. Hey, it's looking to me like, this home is priced about 20% higher than other renovated comps in the area. And he did explain to me that there's certain streets that are kind of higher quality than others. And this specific street is kind of one of the more desirable or one of the kind of prime areas. So he said that's the difference, is that it can be street by street, the value that they can command. So I would just make a note on this one. Like, I would want to inquire about that. Again, we say in all of our webinars, I would want this property to appraise. That's important to me. So I would, maybe ask him. He said he could provide some additional comps that support the list price. So I would definitely request those if I was looking at it. So in my analysis, I did rerun the deal check pro forma. Assuming slightly lower purchase price if by chance it had to be reduced if it didn't appraise. And then I also reran it with that slightly lower rent at the $1,450. And the returns remained very consistent. It was kind of an equal, a proportionate reduction in both. So the returns still remained really strong. So that's why I still felt like even with that discovery, this would be one I would be really interested in moving forward with. Okay, so that is it. I want to, what I love about this exercise is that, and I hope what you guys have gained from this, is that investing is highly individualized, right? We all have different lenses that we're looking through. Something that is absolutely like a hill to die on for one person is nothing to another investor, and that's okay. And when we talk to investors, sometimes I do feel like they can get hung up on searching for the right answer. Like there's one, as if there were one property that was the one that should be purchased. And so I hope what you can see is that even a group like us with all different experience levels, all different preferences, we can all kind of see the benefit of a particular deal. And hopefully we got you thinking about some creative ways to do due diligence too. So if you liked one of those deals that you saw, these are all available. We didn't actually buy them, though some of us might, I don't know. They're all available. So you can scan this QR code here. We have all of the full deal check performas up, so you can study the numbers in more depth. And then we have the contact information for the property teams there. So if you're wanting to, connect with the team directly to see all their inventory, or if you want to connect with their property manager, you can just follow the links there and get in contact with them directly. If you really liked one of these, I would recommend you jump on this quickly and reach out to the team, because these will probably not stick around. So if you're a little overwhelmed by this, maybe this was insightful, but you're feeling like, okay, like this, I'm not ready. I need to do a little more education, a little more prep. We want to help you in that process too. So we have a ton of education resources available for you on realwealth.com. When you're logged in, we have a learning center where we have articles, blog posts, podcasts, webinar replays, resource guides to help you at any place in your journey of investing. And then you also have the ability to talk with us one-on-one. Myself, Joe, and Stacy, we are the investment counselors here at Real Wealth. So when you join, you're automatically assigned one of us. We can be your guide through this investing process, and we can help you hone in on some of your investing criteria and perspective and kind of get you pointed in the right direction. And then, of course, as you're starting to talk to teams and consider deals, we can kind of guide you and prompt you through some of the questions and things that you should be thinking about and considering as you move to closing on your first investment property. So we are happy to step in and help you as your investment counselors. Okay, I know we are way over the hour, but there's still quite a few of you on here, and there were some questions that were sent in. So let's jump into a few of these. We might not get through all of these, but we'll get to some of them here. Let's start with this one. Joe, this question Giannis asked about when you were, no, it wasn't Joe. This was Grant. When you were talking about Cleveland, he asked if you can speak to the local agent in charge policy in Ohio.
What I understand from the local agent in charge, you do need to have somebody that lives there in Cleveland area to be, quote, responsible for your property. So if you don't have somebody, either yourself or somebody the property team does help you out with that. There is a fee for their service to do that, because they do take some responsibility. But I would highly recommend reaching out to the team themselves, asking them about it, and they'll be able to guide you through that as well.
And that's in Cleveland. It's not the suburbs around Cleveland.
Yes, correct.
Okay, there's a couple questions here. Joe, how about you take this one? The questions generally are whether property taxes vary for in-state investors versus out-of-state, owner occupants versus landlords.
Generally, no, but it depends on the market. In Indianapolis, you can have a situation where an out-of-state investor will be taxed at a higher rate. But the other markets, I'm not aware of any other that have that.
Chintan asks if we can explain what a cap rate means. Stacy, do you want to take that one?
Yes, Joe explains this the best, but let me give it the first go, and he can help with the rest. So the way I explain it to people is that it's a metric to evaluate an investment's performance without debt. So variable rates and one having a higher interest rate versus another, it can change your metrics tremendously. So it's a way to have an apples to apples comparison of real estate investments without debt. But Joe, what am I missing?
Nothing. That's
Okay.
exactly right. It's if you bought the property all cash, what would your return be? So if you bought a house for 200,000 and it yielded 10,000 a year in cash flow, that would be a 5% cap rate. So it's a good way to compare one property to another, as you said.
You do that so well.
Okay. Rory writes in, Rory has some investing experience in Cleveland, and it sounds like he's aware of some budget cuts to some Section 8 contracts in Cleveland. So he's had some experiences that have been affected by this. So this is a good point, Rory. There can be legislative changes and budgetary changes that have some impact. So definitely good to know. When I was investing in Cleveland initially, the property manager that I worked with at the time, this was with a different manager. It's not the one we work with, but they had advised me that certain municipalities in Cleveland, their Section 8 process was trickier than others. So it's definitely nuanced. I think in your due diligence, you definitely want to lean into the expertise of that property manager and then know that things can change too, unfortunately. Okay, Anne has a question about the Adamsville house. Which one was the Adamsville? Was that the?
That's mine, Birmingham.
She wants to know, is it on, did you recall if it was septic or sewer?
It's septic.
Any thoughts on purchasing a home with septic? Does that scare you?
No, I have a couple homes in Florida that are on septic. And in Florida, for example, areas are growing so fast, the infrastructure, the water sewer systems can't keep up. So virtually all the new houses are on septic. So it doesn't bother me at all, as long as it's modern. And that was rehabbed as part of the renovation. So as long as it's modern septic, not an older system, 20 years old or older, I have no problem with septic.
Yep, same. I'd get it inspected as you're getting under
Yes.
contract to know for sure. Okay, Teresa asked a question about the Chattanooga property. So Celia, this one is for you if you know this information. They asked, since the current tenant is about to leave, who is going to cover the repair or maintenance and vacancy costs to get the property ready for the next tenant?
Really great question. So the team is assuming ownership. They are buying this from the previous owner, and then they are going to do a couple modifications. And I forgot to mention there was no major expenses that they were going to do, but like they were cleaning out the garage to make it usable. It hadn't really been a usable space, so they are covering all the expenses. They said it should only take a couple of weeks. And oh, now I'm kicking myself. I'm just remembering they are offering a tenant guarantee on that property. So there will be no vacancy on that property. And he was very confident in their ability to get it tenanted even before they closed with the next buyer.
That's great. That's an unusual opportunity. I mean, so this was a little bit atypical from the typical rental resale. Because oftentimes that make ready cost is on you, the new buyer, who's buying it. So that's great that they're wanting to take care of some of those expenses for you even after you purchase it. Okay, Marilee asks about the name of the property management company that is being used. We have all that information on the portal. So log in to your RealWealth account, go to realwealth.com, log in, and then you can hover over properties. You'll see the drop-down window of all the different markets there. You can click on the market that we discussed and see a full hour-long webinar that we've done with each one of these teams, where we go in depth on their property management. We go in depth on all of the fees that they charge, how they screen and place tenants. You have a ton of resources to learn more about the property management. And some of them are willing to manage properties that they don't sell you. So if you already have some properties in one of these markets, some of them are willing to manage homes that you already own from outside of them. Okay. Jonas asks me about the Columbus, Georgia property. Is that in a good appreciation market? My take on this, Jonas, is no, probably not. These small military towns tend to be very slow growing. They're growing in large part because of the military base, and things like housing allowance and military pay are very steadily increased each year. So you should see some moderate increases. But my experience with most military towns, if they're primarily military towns, they are not appreciating very much. So this would be a cash flow play. I would not put my money here hoping that it doubles in 5 or 10 years. It's a long-term purchase. I meant to add, because I saw Steph and Sandy are on this webinar, there's a Piggly
Hey.
Wiggly. Yeah, Steph and Sandy are Joe's clients, and they toured with me in Chattanooga, and we were joking about the grocery store Piggly Wiggly. It's a small town grocery store chain, and ironically, that house in Columbus has a Piggly Wiggly just down the road. So Steph, Sandy, you guys can check that one out. It checks that box at least. Okay, there's one more question here about Indianapolis, and since we have some very experienced Indianapolis investors, we've got to ask this. Rebecca, what type of natural disaster insurance is required for the Indianapolis area? Flood, tornado, etc. And can you provide an average?
So my understanding is nothing special, and Grant can probably confirm from our own properties, just normal insurance for an investor, and it's pretty reasonably priced. Grant knows the numbers, right? What do we
Yeah,
pay? 1,000?
It is, I budget about $100 per property per month. So
And
it's
a
not
little higher priced than what even the team is offering, so it would probably be less than that, but nothing fancy. And it's, even if you get a hail damage, you're going to get your roof replaced with regular insurance.
Yeah.
And in every market, if it's in a flood zone, the lender would require flood insurance, but it's going to be rare that you're going to find that in Indianapolis, and you always want to look out for that in any market.
Yeah.
I think the teams mostly try to avoid flood zones.
Most of the teams do avoid flood zones, but it is always a good question whether or not it is in a flood zone.
Yeah. And the
Yeah,
pro
we have-
forma for each of those properties has an insurance line on it, so you can see what the insurance expense is, and you can see there's not a whole lot of risk to the insurance company because the expenses are very moderate.
Yeah.
We
But
have two
also-
great insurance companies that we work with, Steadily Insurance and NRIG. They're both listed on our website under investor resources. They have free instant quotes. So you can put in an address, put in some of the basic details of the property, and you can get a quote generated for you there on the spot. So definitely, as a part of your kind of further due diligence, run a quick quote and just check the numbers that the team is providing you too. Okay, guys, I think we're going to end it there. This was really fun. We need to do these more often. We need to try to bring these in once a quarter at least, because it's just fun to get in everybody's brain. I hope you enjoyed this. I hope this helped you take a step forward in your investing. And hopefully we'll see you back here for next week's webinar. Thanks so much for joining. See you, everybody.
Bye, everyone.